What's good, YouTube? So, everyone wants to always know about account growth, whether you can grow a small account into a big account, because that's why we're all here, right? We're all here to make money, take a small amount of money, turn into a large amount of money. The difficulty is understanding that that skill set is, while extremely valuable, is very rare because most traders fail. 90% fail. So if 90% can't do it, it probably means that it's very quite difficult to do. But there are people who have done it and have publicly done it, and therefore it is an achievable thing to do. And in order to figure out how they do it, I prefer to talk about the math and risk structure around how one could possibly go about doing that, because most people are simply just gambling and they're just risking their either half or their entire account on these plays, on these trades, and they just lose everything trying to replicate what other people have done and wonder why they can't do it. So let's talk about the math behind this. So most people don't actually grade setups, and I think that's really important towards when you're trying to grow an account, because taking the same amount of risk on every single trade is stupid. Okay, I'm telling you that now. If you're doing that, you need to stop, because you clearly haven't really figured out how to grade your setups, and it's probably because you don't have a playbook. Stop, get a playbook, understand how to read market structure, understand how to read confluence. I literally have made a confluence indicator. I've literally made indicators that help with all of this nonsense. So hey, I know I'm promoting what I've built, but it fucking works. Like, I have people in my school community telling me it works. So hey, I'm just offering it to you. But you need to get a playbook and understand that you cannot risk the same amount of money on every single trade, because every single trade doesn't have the same amount of confluence factors working to make it an actual profitable trade. Okay, so the first thing you need to do is to figure out what are my A playbook trades and what are my B playbook trades, and how much do I want to risk on those trades. That will determine if you can actually grow that account and hit your profit target. So A setups are high conviction, high alignment, everything lines up. B setups are decent ideas, but they're missing a few confirmations or confluences. Okay, do not take anything below a B setup, because you're wasting your time. You can take those other setups on a different system, maybe like negative risk reward or 101 or something like that. That's totally fine. But if you're actually trying to compound and grow an account, you cannot afford to take anything less than a B setup, because you need to have, you already you're most likely going to have a lower win rate, because for compounding you need to catch runners. Like I'm just telling you this now. Let's not waste any more of your time. You need to catch runners. And in order to catch runners, that means your win rate is going to go down. If it goes below, I believe is it 33%? I would say you don't, the higher the win rate for when you're catching these runners, the better. But like, if it falls below a certain threshold, you're no longer going to be profitable, because at minimum, we're going to be looking for 3R multiples on these trades, because that's how you do exponential compounding growth. So A setups, high conviction, high alignment. B, they're good ideas but missing a few confirmations. Create a playbook and figure out exactly what that means for you, because everybody trades differently. I trade quarter levels. You might trade supply and demand, right? I technically trade all of those things. Like I look for confluence with all of those things. I look for support levels. I look for supply and demand levels. I look at quarter levels. I look at moving averages. That as many things in my favor as possible will increase the likelihood that I'm going to win that trade. And I look for all of those things. But the primary way that I look at the market as a map is quarter levels. I've talked about that in plenty of other videos. I talk about that in my school community. If you want to know how to do that, link in the description box below. So now that we got that established, that you need to get clarity and structure on how much risk that you're going to be risking per trade, let's talk about the math behind it. Okay, so let's break down what exponential growth actually looks like. Okay, so at a 25% risk and a 3R reward, every win multiplies your balance by 1.75. Okay, so every loss cuts it down by 0.75. So I have the numbers on screen. So let's say you start with $1,000. One win, you're at 1,700. Two wins, you're at 3K. Three wins, you're at 5.3K. Four wins, you're at 9.3. Five wins, you're at 16.4. Okay, so sounds good on paper, I know, but you're not going to win 5 straight winners at a 3R multiple. Nobody does. Okay, so here's the part that most people miss. You don't need to, because compounding doesn't care about streaks, it cares about averages. If your average win is 3R, if your average loss is 1R, you can literally lose more than half your trades and still come out ahead. And we're going to prove that next with a actual simulation using real probabilities. And trust me, it's going to surprise you. All right, so I ran a simulation with 40 trades with a win rate that fluctuates randomly between 35% and 55%. Half are A setups at 25% risk, half are B setups at 12.5%. So basically a realistic trader, not a robot, not a guru. And here's what it looks like. You can see that the trend starts pretty good, right? And even with average accuracy, the compounding still pushes the account higher over time. This is what I call imperfect growth, because you don't need to be perfect. You just need to stay in the game long enough for your edge to express itself. But now I want to address something that a lot of people are probably thinking, is that look at the fall off. So you start pretty amazing, like the account pushes all the way to 35K and then have a steep pullback all the way to 15K with a rebound to 25K, another pullback, rebound, and then you start to slowly bleed out. This is quite literally what usually happens to traders who grow their account really quickly and then lose it all. Because once you get to those really high account balances, you're still trying to risk a large percentage of your account per trade, and your psychology have not yet adjusted to your new balance, and therefore you become even more emotional about these trades, and that's how you lose everything. That's how you completely blow up. So understanding that this isn't really sustainable long term is really important to really like nail home. Like, is it possible? 100%. It's possible. Even with a win rate dropping to 35%, like that's pretty low. But the law of large numbers and averages takes over and propels you to your profit objective. The problem is that it's not sustainable. It's not sustainable long term at all. So after you get to these high account balances, you might want to consider dialing it back. You know, unless you're okay with the potential drawdown and okay with potentially losing everything. So this is just 40 trades, right? It's not like 100 trades, because we were trying to get this down into a 90-day time frame, which is about 3 months. Some of y'all are trying to do this in 30 days, which is just absolutely insane, and pretty much why, you know, you keep refunding the account, because you're risking way too much on the trades and you're not giving yourself enough time. Like, professionals even give themselves a year or more to do these things, and you're trying to do it in a month. Like, let's slow down, hero. Like, let's really think about what we're doing here. So with the equity curve at 35% to 55%, and you're compounding your risk, meaning that you initially start out risking $125 on B setups, $250 on A setups. Your risk goes up as your account balance goes up, and that's why you see this dramatic compounding and really crazy growth. You're essentially betting on you inevitably having a winning streak, which everyone does, including people who trade high risk, low risk, high reward models, meaning you're risking 1 to make 3. Like, they hit winning streaks a lot, which is why they become so addicted to that model, is because sometimes they initially start out with the crazy win streak and think that that's the holy grail, right? And there is no model that's the holy grail. It's just, how consistent can you be with whatever that you're trading, and do you know how to play defense just as much as you play offense? So some people might be wondering, like, can you use a negative risk to reward to do something like this? And I'm of the opinion that it's really really a bad idea. I would highly recommend not doing that, because NRR is designed for smooth, high win rate performance. So you might win 7 or 8 trades out of 10 and your account doesn't spike, it glides. So you get a really smooth equity curve that's up and to the right, but it doesn't fit into a small account compounding model, because when you're trying to grow 10x, you need asymmetric trades, meaning you need explosive reward potential. If you risk 25% with that negative risk to reward model, you're dead in 3 losses. It's over. It's over for you. It's over. I'm sorry. It's over. The math just doesn't forgive. It doesn't forgive. So my rule of thumb is, if you're using that NRR, you can use it for prop firm or for building consistency. But like, if you're really trying to go with a growth model, you need to do at least 3R asymmetric bets, asymmetric trades, like really blow it out of the water, because you will blow up your account trying to do this with a negative risk to reward model. So I really want to drive home this point so that you get the most value from this video, and that's understanding expected value. So at a 45% win rate, which is in between what I showed you in that diagram, 35% on the low end, 55% on the high end, 45% is in the middle. A 3R target, your expected value, or EV, looks like this. EV equals all these numbers. I'm not going to read it out loud because it's just redundant. So you have an expected value of 0.8 R. That means every trade on average, you're adding nearly 1 R to your balance. That is a mathematical edge. You have a system, a trading system that has a positive expected value, meaning you should not blow your account, even risking 12.5% to 25%. Can you blow your account? Absolutely. You can blow your account, but the objective is to grow your account. So what? No risk, no Rari. If you're trying to grow your account and you actually have a trading edge and you have a playbook, then swing for the fence. As long as you have some form of outside income to fuel this potential account compounding system, this account growth system, you're fine. But if you take no outsized bet, you get no outsized reward. If you take no asymmetric risk, you get no asymmetric reward. If you take anything from this video, understand that if you take 0 asymmetric risk, you get 0 asymmetric reward. So stop putting all this emphasis on this account flip working this time. If you develop the skill to make it happen, it can eventually happen, but understand that it might come at significant losses. Can you afford those losses is the question, because if you're putting all this pressure on this account flip to be your way out of whatever financial crisis that you're in, you're going to blow up, and it's not going to happen. And even when you do make that money, you're going to lose it all, because you actually haven't learned defense. You only learned offense. Okay, I've already showed you the account, what it looks like mathematically, that you're most likely, even if you hit that profit target, will blow your account. Long enough, risking that much, eventually you'll hit a losing streak and you'll blow your account. So playing defense literally just means sizing down. That's it. You go from risking 25% to risking 10% to risking 5%. The gains will get smaller, but so will the volatility in your equity, and so will your emotions calm down. They'll settle down, and you'll be able to continue to take these hits and take this risk, and then compound your account to whatever profit objective that you're trying to get to. But if you get too emotional about it, it's not gonna happen, man. It's not gonna happen. The first thing you need to do is develop a playbook. Okay, so develop a playbook. Once you got your playbook, figure out what you're going to be risking on these trades. I've already told you it's 12.5 and 25%. After that, if you inevitably do hit this profit objective of 10K, size down. I know some of y'all will not be satisfied with everything, all the value I've already given. So I'm going to give you at least one playbook play that I use, which is simply a break and retest. Break and retests are bread and butter setups. They work because of market structure, because of order flow, and all these other things that help create the structure for a high probability setup. So break and retests are just so simple. You have resistance, it pulls back, it breaks the resistance, it pulls back, and then it proceeds to the next level. That's literally what you're seeing in front of you on the chart. Like literally what you're seeing. This is the 5-minute time frame. Okay, so we have amazing confluence. This is a 5-star. I'm just using the things that I use. Okay, I'm using my indicator. This is a 5-star level flame emoji because it's had at least 40 reversals off of it, which is freaking amazing. So I set limit orders. Your entry model is up to you. I'm once again just telling you what I do. I know this is a cherry picked example, but this is quite literally the type of trades that I take. So I'm looking at the level. I see multiple rejections off of it. We have multiple reversals off of it. Cool. It's a whole number. It's 157.5. Perfect. I got my limit order. What's my stop loss? Is probably 2 times ATR. ATR right now is 43. Let's round it up to 50. 2 times ATR is $1. Cool. Risking $1 to make $3. It clearly hit that limit order. Boom. You're in here. This is early in the morning. Boom. You're in. It hits your TP at about 2 hours. 2 hours it hits your TP. How do you maximize for profitability, but also getting a higher R multiple, so you don't just take your full trade off of a 3 R multiple? Cool. You have a choice. You can either close your whole entire trade at a 3 R multiple, or you can take off 80% at a 3 R and trail your stop. Okay, you can trail it with whatever moving average you want to. You can trail it with the 200 period moving average on the 5-minute time frame, which is a really low time frame, but it's pretty good for trailing your stops. You can trail it with a 50, a 30, like pick up moving average and trail it with it. Let's just say the 200 period moving average, okay, for on the 5-minute time frame, just to give you some type of structure, because some people will literally like, I don't know what to do. No problem. Take 80% off of a 3R, trail the rest with the 200 period moving average, move your stop to break even, you're done. And then just look for confluences like that. If price is above the 200 period moving average on the 5-minute time frame, that's usually a really solid confluence indicator that you're taking a trade in the right direction on the lower time frame, because I know a lot of you trade on the lower time frames. You can even see here that we had a break and retest, and I think let's see, so you would have got stopped out here even at 2 times ATR, even though it's a clear break and retest, right? We see resistance right here. So this is a clear level. So look, resistance. We got above it, we retested it, but you got liquidated with a tight stop loss, because one, $1 stop loss is pretty tight, but two, we were still below the 200 EMA on the 5-minute time frame. So you don't have all your, this would be like the equivalent to a B setup versus an A setup. You see what I'm saying now? Like A setup has everything going for it. B setup is like, okay, we got a break and retest, but price is still below the 200 EMA, so I'm gonna risk 125 instead of 250. So you could have easily take this loss. You could have took that loss. I don't know if you wanted to re-enter. Like, it's up to you. You could have re-entered, and the second trade would have worked, and the third trade definitely would have worked. Okay, so we have all the confluence indicators. We got a clear level. We get prices above the 200 EMA. We got good confluence. So that's what I'm saying. Like, you need to make your own playbook to get very specific with the type of trades that you want to take. And you would have still been in this trade on a 200 period moving average on a 5-minute time frame, and you just floating, waiting to see if it goes higher. Okay, so I hope that was a very powerful and impactful video. Link in the description box below if you want to join our amazing community full of traders who are just amazing, growing, giving a lot of feedback. And if you have any thoughts, any questions, any concerns, drop in the comments below. I will see y'all in the next one.